Welcome to Mythos AI, your source for Cliff's Notes on complex subjects. Join Anna and Phil for yet another engaging conversation.
Welcome to the Deep Dives, where we take complex topics and, well, distill them into essential insights, giving you a shortcut to being truly well-informed. Today, we're embarking on a pretty crucial deep dive into Europe's strategic vulnerabilities and a bold, some might even say radical, vision for its future. We're sifting through expert analysis on Europe's dependencies, particularly its financial ones, and we're examining the proposals for deeper integration put forth by Mario Draghi back in August 2025. Our mission today is to understand not just what these challenges are, but to really grasp precisely why finance sits at the very heart of Europe's capacity to act independently, decisively in this rapidly changing world. So to kick us off, why is finance a foundational element? Why start there for Europe's strategic autonomy?
Well, fundamentally, it's because without that bedrock of, say, collective borrowing, a truly strong euro, and a much more integrated fiscal union, well, virtually none of Europe's other strategic ambitions can really take hold or function effectively. We're talking about building a credible common defense, achieving genuine energy independence, or leading in cutting-edge areas like AI and semiconductors. None of that works without the financial underpinning. Europe currently finds itself navigating a multipolar global system, sure, but often it feels more like a spectator than a primary actor on the stage. To give you an example, think about the rapid deployment of green tech subsidies in the U.S., or maybe the huge state-backed AI initiatives you see coming out of China. Europe, despite its individual member states having strong economies, often finds itself sort of watching these global power plays unfold rather than actively shaping them. And this is mostly down to fragmented financial firepower. The long-held idea that just having economic weight would automatically give you geopolitical power, that illusion's really been shattered. Mario Draghi's diagnosis from 2025 really underscores this. He highlighted how these interconnected dependencies across all sorts of key sectors create a kind of systemic fragility. His view is pretty stark, actually. Without a fundamental, truly transformative shift in its financial architecture, Europe genuinely risks strategic decline.
Wow, okay. That certainly sets the stage for a much larger and frankly more urgent conversation. Can you give us the bigger picture? Where does this deep dive fit into our broader look at Europe's challenges?
Yeah, so this deep dive is part of a wider series where we're exploring Europe's structural challenges in what people are calling a post-unipolar world. That's basically a world where, geoeconomics, security worries, supply chain resilience, these things are increasingly dictating international relations, maybe more so than traditional diplomacy. And this particular focus follows Mario Draghi's really significant federal call back in August 2025. Now, just to clarify for everyone, this wasn't just another policy paper. It was a fundamental challenge to the EU's current structure. He was essentially calling for a dramatic shift towards a genuinely federal model, almost envisioning something closer to a United States of Europe, you could say, where common institutions would hold much greater fiscal and political power than they do right now.
Okay, a United States of Europe. Let's unpack that a bit more. Given all the challenges Europe faces, defense, energy, tech, why start with finance? What makes it the absolute keystone?
It's the keystone because, quite simply, everything else hangs on it. The financial fragmentation you see in Europe right now, particularly the fact that its banking union and its capital markets union aren't fully complete, well, that directly prevents the efficient pooling of capital across the whole bloc. And that means Europe just cannot fund the huge, large-scale strategic projects it desperately needs if it wants to assert itself effectively in critical areas. Think advanced tech, defense, or green energy. It's not just a vulnerability. It's really a foundational constraint on what Europe can realistically aim to achieve.
That makes the stakes incredibly clear. But let's get down to brass tacks. What are the actual vulnerabilities Europe is grappling with right now in its financial setup? Where are those critical points of dependency making it fragile?
Okay, well, one of the most significant ones relates to the global financial order itself. That order is still heavily influenced by the US dollar. Europe's institutional design is, in many ways, kind of a legacy system. It was built for a different world, a world where you had a stable, arguably benevolent hegemon like the US, guaranteeing security, and a predictable rule-based financial system. But the current paradigm, it's driven much more by geoeconomics, security, supply chain stability. It's not solely about market efficiency anymore. So this continued reliance on external financial structures, the dollar being the prime example, makes Europe really quite vulnerable to economic coercion and, external shocks.
And what about the internal structures you mentioned? The banking and capital markets unions. What exactly are they, and why does their incompleteness cause these problems?
Right, so Europe has what's often called an incomplete banking union. Now, it does have a single supervisory mechanism. That means the European Central Bank directly oversees the biggest banks. And it has a single resolution mechanism, which is designed to handle failing banks in an orderly way. But the crucial missing piece is a common European deposit insurance scheme. So what that means for you is if your bank, let's say in Portugal or Italy, faced a really severe crisis, your deposit is still primarily protected by national funds, not by a shared, robust European safety net. And this lack of completion, well, it sends shivers through cross-border lending and stops banks merging across borders as easily as they might otherwise. It hampers efficiency across the continent. Then you got the Capital Markets Union, or CMU. That's also far from complete. Just to illustrate how weak it is, think about this. The total market capitalization of all of Europe's stock exchanges combined, it's about 60% of Europe's GDP.
60%. How does that compare elsewhere?
Exactly. That's less than half the figure in the U.S., where it's over 120% of GDP. And this persistent fragmentation, which is still largely along national lines, makes it incredibly difficult to finance the kind of high-tech investments Europe needs. We're talking AI startups, semiconductor factories, things that typically need equity investment, not just traditional bank loans. This inability to pool capital efficiently right across the block. That's what some call the financial root of Europe's middle technology trap. It stops the funding of these crucial large-scale projects in really cutting-edge fields.
It really sounds like individual national budgets just aren't big enough anymore for Europe to truly compete globally on this kind of scale.
Precisely. Fragmented national-level efforts to fund these big strategic projects are simply, as the analysis puts it, insufficient. They can never achieve the necessary scale to go head-to-head with global rivals like the US and China. And this financial architecture, it's a direct consequence of creating what's been called a substandard monetary union, basically. They created the euro, but left the existing national fiscal and financial systems largely in place. That severely limits Europe's collective financial firepower. It's a bit like having a really powerful engine, but without a fully integrated chassis and steering system to make use of it.
And you mentioned the dollar's dominance earlier as well. How exactly does that play into Europe's current financial dependencies?
Yes, the dollar's dominance. It's a critical and sometimes overlooked aspect of Europe's vulnerability. The US dollar is still the world's main reserve currency. That means it's used for the vast majority of international trade and financial deals. Now, this exposes Europe to US monetary policy decisions, obviously, but maybe even more critically, to what are called extraterritorial U.S. sanctions. So, for example, even if Europe as a bloc wanted to trade with certain countries, if those transactions touch the dollar system, they can be directly impacted by U.S. foreign policy choices. If Europe genuinely wants strategic autonomy, it needs a euro that can really stand as a robust, independent alternative on the global stage. That would give it much more control over its own economic destiny.
Okay, so if that's the comprehensive diagnosis of the problem, fragmentation, incomplete unions, dollar reliance, well, what's the radical prescription? What is Mario Draghi actually proposing to, well, pull Europe back from the brink and tackle these deep-seated financial issues?
Draghi is proposing nothing short of a radical shift, a move towards a whole new era of integration. And a central part of his vision is the widespread use of common debt instruments. Now, he makes a really critical distinction here, one that's often misunderstood. He talks about bad debt versus good debt. Bad debt, in his view, is borrowing that just funds current spending, like day-to-day government running costs. Good debt, on the other hand, is debt that finances strategic investments, things that enhance productivity. Think of it like
borrowing to pay the monthly grocery bill versus taking out a loan for a new factory.
Exactly. Or investing in a state-of-the-art solar farm that will generate revenue and boost energy independence for decades. That's good debt. And he argues this good debt just can't be raised effectively at the national level anymore, not for the scale needed. It requires some form of common debt to fund these huge European projects that fragmented national efforts will simply never achieve on their own.
How much common borrowing are we actually talking about here? And how would this fundamentally reshape Europe's financial landscape?
The estimates Draghi put forward suggest Europe needs to invest something like $1.2 trillion annually over the next decade.
1.2 trillion.
Annually, yes. It's a huge number, but it reflects the sheer scale required to genuinely make an impact and close that investment gap with global competitors. This common debt, this mutualized borrowing, would provide the capital needed for these massive projects, AI, semiconductors, defense, green technologies, you name it. It would effectively fix that stunted governance architecture we talked about earlier, where Europe created a single currency, but without a truly common fiscal policy to back it up. by pooling resources, creating a new class of safe pan-European assets, think Eurobonds, but maybe under a different name, and potentially lowering debt service costs across the bloc. This mutualized borrowing could attract significant private investment, and it would send a powerful signal to global competitors that Europe is absolutely serious about its strategic ambitions.
Okay, common debt is a huge piece.
Oh boy.
But beyond that, what about strengthening the euro's role on the world stage?
Draghi sees strengthening the euro as absolutely paramount. A stronger euro, one that's more widely used in global trade and finance, directly reduces Europe's dependence on the dollar. It would give Europe more monetary sovereignty, basically insulating it better from external financial shocks and the geopolitical leverage that dollar dominance gives other nations, particularly the U.S. It means less exposure to U.S. financial regulations, less vulnerability to those extraterritorial sanctions we mentioned. It's really about giving Europe its own distinct voice in global finance.
And what about the plumbing? The
Yeah.
payment systems. Why are EU-controlled payment systems a key part of his vision?
All right, the plumbing. Currently, much of the world's financial infrastructure, especially for cross-border payments, relies heavily on systems like SWIFT, which are significantly influenced, if not dominated, by the U.S. This makes Europe vulnerable, again, to those U.S. extraterritorial sanctions. The U.S. can effectively use these systems to influence or even block European economic activity with countries it doesn't approve of. So Draghi argues very strongly for developing robust, independent European payment systems. This would ensure Europe can conduct its own trade and implement its own foreign policy without constantly looking over its shoulder for fear of external interference. It's really about securing your financial infrastructure, just like you'd secure your physical infrastructure. It's a critical piece of genuine strategic autonomy. And beyond these really big ticket items, Draghi also calls for more specific reforms to the internal market, things like removing national barriers that stop companies operating easily across Europe in new tech sectors. And crucially, accelerating the creation of a true, fully functional capital markets union, not the half-finished version they have now. This would also likely involve adapting EU competition rules. The idea is to help European companies scale up properly in strategic industries so they aren't constantly overshadowed by much larger American or Chinese players.
The economic logic behind all this seems incredibly compelling. Almost, you might say, irrefutable from a purely rational standpoint. But as we've seen so many times in Europe, good economics often crashes headfirst into political realities. What are the biggest political roadblocks, the major hurdles that could potentially derail this whole vision?
You're absolutely right. Despite the clear economic case, Draghi's vision faces some really deeply entrenched political obstacles. A major one is what some analysts call the Confederation reflex. Now, to understand this, the European Union, as it stands, functions largely like confederation. That's essentially a union of sovereign states that keep most of their individual power and decision-making authority. Key things like taxation and defense. Still largely national. A federal state, on the other hand, think the United States or Germany has a central government with significant powers that can, in certain areas, override the constituent states. Europe often gets stuck because it hasn't fully made that leap. National interest too often trumps collective European action. It's a structural issue.
And does this confederation reflex translate directly into specific resistance to the idea of common debt, particularly from certain countries we often hear about?
Absolutely. The proposal for mutualized debt, or common borrowing, is incredibly politically sensitive. It creates that classic north-south divide you often hear about in EU politics. Historically, countries often labeled as frugal, typically Germany, the Netherlands, sometimes Finland and Austria, have strongly opposed common borrowing initiatives. Their main argument is that it creates what economists call moral hazard.
Moral hazard, can you break that down?
Yeah, in simple terms, it's the fear that if everyone's debts are effectively pooled together, some countries might become less disciplined with their own national spending, knowing that, ultimately, others might have to help foot the bill. It's a bit like if you share a credit card with friends, the worry is some might spend recklessly knowing the debt isn't solely theirs. So this opposition comes from a deep-seated belief that one country shouldn't be forced to pay for another's past deficits, and it could lead to, well, an abandonment of fiscal restraint across the board. It's a fundamental ideological clash over fiscal policy, risk-sharing, and national responsibility that has really deep historical roots within Europe. And beyond just this fiscal argument, there's also that profound sovereignty reflex we touched on, a deep-seated, almost instinctive resistance in many capitals to ceding more national power and control to Brussels. While past crises, like the Eurozone crisis or the pandemic, have sometimes forced steps towards more integration, a truly fundamental transfer of fiscal and political power. That's often seen as a direct threat to national identity, national control over budgets, and even democratic accountability back home. The EU's current political system, which often relies on consensus among all member states, is, quite frankly, often ill-suited to the kind of speed, scale, and intensity of the changes Draghi is advocating for. It really boils down to a fundamental question about what kind of political entity Europe truly wants to become in the 21st century.
Okay, so connecting all these threads, let's look at the potential futures. What are the likely outcomes if Draghi's vision, this federalist push, is actually realized? And conversely, what happens if it isn't, if the roadblocks win out?
Right, the scenarios. Well, if Draghi's vision of federalization somehow succeeds, it would mean a fundamentally stronger euro on the world stage, real fiscal muscle for the EU as a whole. And crucially, it would lay the indispensable foundation for genuine European defense capabilities, real energy independence, and true digital sovereignty. Common debt would provide the capital for those massive investments in AI, chips, defense, green tech, enabling a unified European industrial policy that could actually compete effectively with the US and China. An accelerated, completed capital markets union would unlock vital equity funding for dynamic, growing sectors like biotech and space exploration. A common funding mechanism for defense could finally start to address the massive fragmentation and inefficiency in European military spending, achieving vital economies of scale. And similarly, common borrowing for energy could fund huge continent-wide projects like clean energy generation and a truly unified smart grid, moving Europe decisively beyond its reliance on volatile external energy markets. It's potentially transformative. Conversely, if it fails, if the political hurdles prove too high, then Europe likely faces continued and probably deepening dependency. Fragmented national budgets will remain just as they are now, perpetually insufficient for these strategic scale projects. That likely means continued reliance on the US dollar and quite possibly an increased dependency on US military protection and technological leadership. The outcome in that scenario would essentially be a kind of managed strategic decline. Europe risks becoming a more marginal player, maybe a kind of large, prosperous museum, but essentially a bystander in a world increasingly shaped by great power competition. It would be bound by its own institutional inertia, unable to effectively address the systemic vulnerabilities that Draghi and others have so clearly identified. It really is a fork in the road with vastly different destinations ahead. So after all that, what's the ultimate bottom line from our deep dive today? What's the key takeaway?
I think the bottom line is crystal clear. Finance isn't just another policy area for Europe. It's not just one item on a checklist. It is the indispensable foundation for its entire future. Mario Draghi's vision, this push for a more federal-style union powerfully supported by common borrowing and strengthened financial autonomy, it is radical, no doubt about it. But it's arguably a necessary response, given the unprecedented scale of the challenges Europe is facing, the choices being made right now, the decisions about financial integration. They will profoundly determine whether Europe actually builds a robust sovereign union that's genuinely capable of securing its place and its values in the 21st century, or if it effectively accepts a path of continued dependency and ultimately strategic decline. The stakes are really that high. We really hope this deep dive has given you a clearer, perhaps more nuanced understanding of the critical juncture Europe faces right now and the profound implications of its financial decisions, implications that reach far beyond Brussels or Frankfurt, affecting all of us. Thanks for joining us.
Thanks for listening to Mythos AI. Stay tuned for more concise insights. And remember to hit the like button and subscribe for future episodes.